So we move on to Article 3, which is transaction value of similar goods. So you'll find that in case you reject a previous method, it does not mean that those goods are going to be stay with customs. They're not going to be released because we were not able to do transaction value method supported by Article 1. So when you reject the first method and Article 1, then you move to the next method. Are you able to get identical goods that were previously imported? And mostly we look at either, you can say 90 days or 3 months. So within the past 3 months, are we able to get goods that were imported into the country and they were cleared from customs? Then that will form our basis for valuing those goods. But in case in our database we don't have transaction value of identical goods, when we go to the database, there's no identical goods that were previously imported, are we able to find similar goods? So similar goods will can be used interchangeably. So you find that they perform same function and can be used interchangeably. But what we need to note is that when we are looking at similar goods, presence of trademark may also make us to do some adjustment, because you'll find that a trademark, even though may be similar because it can be used interchangeably and has the same function, but because of a presence of a trademark, you'll find that those goods may not be able to be valued as similar goods. A good example, you can give an example of a Samsung phone and an iPhone. If I was physically present, watu wa iPhone wangenirushia mai, because even though they perform the same function, they can be used interchangeably, but an iPhone is an iPhone. So you'll find that when we are looking at similar goods, we may need to keep in mind that trademark may play a role in our valuing those goods. So the methods are supposed to be used sequentially. So you move from one method, like supported by one article. So Article 1, if you're not able to use method 1 and Article 1, then you move to the next method, which is transaction value of identical goods. If you're not able to use transaction value of identical goods, now you move to similar goods. So the methods of valuation are supposed to be used sequentially, but you'll find that under Article 4, it gives us, you can say, an exemption from us using the methods sequentially in the two next methods that are supposed to follow. So you'll find that under Article 8 also gives us, it's Article 4. So in Article 4 also gives us the first right of an importer. So first right of an importer. So Article 4 allows the importer to request customs to use Article 6 instead of Article 5. So this support method, 5, remember we have seen the theory. So this is Article 5 support method 4. So the next method was supposed to be method 4 supported by Article 5, and then method 5 supported by Article 6. But this Article 4 gives the importer their first right. So you find that the importer can request customs instead of applying method 4 they apply method 5 first and then method 4. So that's upon the request. So that is a right the importer can request in writing to customs, and customs, you can say they have no reason to say that we are not going to grant your request, especially when the buyer and the seller are related. So you'll find that Article 4, now you can say it breaks that sequentially, but upon request. So it's not going to say that we'll use method method 5 before method 4 because we want to. It has to be upon a request by the importer. But in case the importer does not request, so we move on to Article 5. So Article 5 support method 4. Remember, we have looked at the 3 supported by Article 1, 2, and 3. So method 4 is supported by Article 5. So if there's no request, now we continue our sequential application of the method. So method 4 basically is a deductive value method. So deductive value method basically looks at the unit price. So unit price of goods previously imported into the country. So imported into the country. Sold at the greatest So we're going to look at unit price of the goods that are being sold in the country of importation, but those goods were previously imported into the country. And when we get that data, we look at the quantity. If the price is, goods were sold at that unit price, you can say there are many quantity. So you'll find that previously imported in the country sold at the greatest aggregate quantity. So we look at if this pen is being sold in Kenya, are we able to get maybe 2 or 3 shops that are selling this pen? When we get maybe 3 shops are selling the same pen, maybe one shop is selling at 100, another one at 90, and then another one at 102. So when we get these prices, we are not going to say as customs officer we want to collect revenue. We are going to take 102 as the price. Under this method, it tells us we look at the quantity to guide us which price we are going to take to apply in our determining of the customs value. So you will look at, so this was the price, and then you will look at the number of units that were sold. So if maybe at 100 there were only 50 units, maybe at 90 there were 30, maybe at 102 there were 40 units, then the greatest aggregate quantity, the highest quantity that was sold was 50. So this 50 is going to be our guiding quantity to use this 100 as the price of the goods, that we are going to make some certain deductions to be able to determine the price of the pen. So when you determine the greatest aggregate and you get the unit price that relates to that greatest aggregate quantity, then that is going to be our unit price. So from this example, we have seen that the 100 will be our unit price. But remember, this 100 is for the price that you are getting at the shop in your local area. You go to maybe to a mall, or to the retail shop near you, you find that this is the price that the product is being sold at. But you'll find that this price is net of profit. This price is also net of maybe some general expenses that the trader incurs. Maybe there's some rent that he incurs for the shop, so that he is able to sell the pen at 100 shilling. Maybe there were post-importation costs that were incurred. Maybe there was transport. Maybe the goods is being sold in Nairobi, and the first point of import was Mombasa. So it means there were transport costs to move that item from Mombasa to Nairobi, so that it's now in the shop in Nairobi. So transport, so internal transport or post-importation cost. And then there was that customs duty plus the other charges that were charged at the port of entry. Maybe there's IDF, there's RDL, there's VAT, there's excise duty. So all those will form this. So we cannot say that our basis for valuing this pen now is going to be 100. Sorry. It's going to be 100. We need to now deduct this aspect from this 100. So when we deduct this aspect, then that is going to be our customs value, which will now charge duty, and also we may need to make certain adjustment in relation to Article 8 that we will see when we get to Article 8, and also when we get to Article 5, we'll see what adjustment may be made in relation to determine the value of the goods under the deductive value method. And under deductive value method, you'll find that this is like 3 methods in one. So are you able to get prices of goods as imported? So you have this pen that you're trying to value. Are we able to get this same pen in the shops that in Kenya, so that we use the deductive value method? So are we able to get goods that are as imported or as identical? Maybe there are no goods as imported. Maybe we have an identical. Maybe someone decided that this pen will look nice when it's in a small kind of pouch. So now it becomes identical or similar. So you find that this also means that deductive value method is like 3 methods in one. So are you able to get the same product in our local market, either maybe at the mall, at our retail shops? If they are not as imported, are we able to get identical goods, or are we able to get similar? And remember, we cannot say that we are going to look at similar when you have not ruled out that there are no imported or identical goods. So remember, methods are sequentially applied. Is there an imported item as imported, the same way this pen is? Or if we don't get imported, is there identical and then similar? So remember, methods are applied sequentially. So remember, there are no calculations that I've so far mentioned. It's just the concept that are you able to internalize the concept so that when you want to use 100 or maybe the 90 or the 102, you are able to justify why you are using 100 and not 102, or why the importer wants you to use 90, and you explain that you are not going to use 90 because the GAQ pointed to 100 as the unit price. So remember, concept, not calculations. So that's Article 5. And then Article 6 talks about computed value. So computed value is ideal when we have the importer and the seller are related. because you'll find that then the importer may be able to convince the seller to provide that information because we don't have jurisdiction in the country of export. So you'll find that the computed value is like now you are looking at the export country, but the method is ideal where the buyer and the seller are related, and you'll find that in case the importer requested because of Article 4, then Article 6 may be used before Article 5. So method 5 will be used before method 4. And then Article 7, in case after looking the guidelines or the conditions under the different methods, and we have seen that we have gotten to computed value method, and our goods are not yet valued because under one condition or another we have rejected each and every method. So you'll find that Article 7 is supposed to be a method of valuation, but per se is not really a method on itself or standing on its own. It relies on making some reasonable flexibility on why you had rejected the previous method. Why did you reject the transaction value method? Method supported by Article 1. Maybe the buyer and the seller are related. So the buyer and seller are related. So it means we will not be able to use transaction value. Are related. So we are not going to be able to use transaction value method. But you'll find that we have rejected all the other methods that follow. We have rejected transaction value of identical, similar, deductive value method, and also computed value. So does it mean that we're going to tell the importer to return the goods where he bought them from? Or are we going to say that since we were not able to value the goods, we are going to detain these goods? So you'll find that under Article 7, it gives us that flexibility that since you have rejected because the buyer and the seller, what was the amount of the goods that the buyer declared? Maybe the buyer declared 100 shilling, and we see maybe from the database the people who buy the same item declare at 101 or 100.5. Is this reason enough to delay the clearance of those goods? It's not, because we'll be frustrating trade instead of facilitating trade. So you make that reasonable flexibility. Instead of he has declared 100, but the value is maybe normally declared by buyer and seller who are not related is 100.1. So we make that flexibility. We allow, there's no otherwise. Or it means they either return the goods or we detain them, which we don't have the capacity or maybe the storage space to do that. So you make that reasonable flexibility and you accept the 100 that has been declared. So Article 7 per se is not a method on its own. It's just seeing how best we can be able to make some flexibility in order to value the goods, and so that we are able to facilitate our trade. And then Article 8, we have mentioned, it supports Article 1. So you'll find that those are the adjustments that may need to be made in relation to using method 1. And you'll find that for those adjustments, they need to be supported by quantifiable data. So there's an amount associated with that adjustment. And also it's supposed to be supported by objective data. It's a fact. That cost, objective data. So it's a fact. And then quantifiable data. How much was it? So those are the costs that may not be included in the transaction value, but were incurred pre-importation by the importer to get the goods. So quantifiable data, so supported by an amount. So that adjustment cost, maybe it transport, even though transport is an optional adjustment, so it transport maybe from the export country to the import country. So you'll find that objective data, it's a fact. Those goods were bought from China and now they are in Kenya. How did they get to Kenya? So that's a fact. And then quantifiable data. How much is that transport from China to Kenya? So when we are looking at adjustment, we need to keep in mind we have objective data and also quantifiable data. And also they relate to the goods we are valuing. So these are the goods we are valuing. So it means this transport relate to this good. You don't take transport that was for another consignment and now you add to this goods that we are valuing. So relate to goods being valued. So those are the three things that we need to keep in mind when we are dealing with adjustment, especially if they are not included in the cost or in the values of the goods. So that's Article 8. And then we have other rules in relation to customs valuation. So Article 1 to 8 is the methods of valuation. Article 9 explain the conversion of currency. Remember, those goods that were bought in Kenya were not paid in Kenyan shillings. Most likely maybe they were paid in US dollars. So what amount of conversion are we going to use? Are we going to Google and look at the rate today? Is it maybe 140? So we are going to say we'll apply 140. Maybe someone is able to access the black market and the rate of exchange is 120, which the importer maybe is able. Remember, the importer is looking at having a low value being applied, and for a customs officer, we are looking at a high value being applied. So if we are not able to have clear rules in relation to conversion of currency, then you will find that the customs officer will apply 140, the importer will apply 120. And this will not be fair, because you'll find that some importers may be insistent and convince or try to insist that 120 be used, while maybe another importer may have no otherwise, maybe they require those goods and the customs officer may get their way. So you'll find that if there are no clear rules which value to be used, will be in the losing end, frustrating trade. So you'll find that Article 9 points that at least a member, so WTO member, which is the country that is a member of WTO, have, you can say, an authority, or you can say an organization that is authorized to give out those conversion rates, or the conversion rates that are applicable. And you'll find that for Kenya, we have CBK is the one that gives guidelines on the conversion rates that are applicable, and you'll find that Commissioner of Customs and Border Control advises importer which is the applicable rate. You'll find that the rates are applicable for the week. So you'll find that they will advise the importer which is the applicable rate, maybe for converting US dollars to Kenyan shilling for that week, maybe the week of 21st to until we get the next one. So it's applicable 21st to 28. And then from 29, we get another advice. So CBK are the ones that, for Kenya, are the ones advising the conversion rates that we are going to be used. Otherwise, everyone will give their conversion rate, and it may favor one party or disfavor the other party. So the members are encouraged to have either an authority, an entity, an organization that will be guiding on that conversion rate. And then Article 10 talks about confidentiality. remember, there's a lot of information that is shared from the importer when they're making the declaration, or when maybe customs wants clarification and want more documentation. And like for the case of Article 6 for computed value, you'll find that the importer may provide the costs, the raw materials that the seller uses. So you'll find that if that information gets to wrong hands, it may be misused. So there's that need to have confidentiality. So any information that is provided is supposed to be kept confidential. So you can say another right for the importer, that information they provide is not going to be displayed that so and so imported this item and this is the amount they have declared. Or maybe he imported this motor vehicle from this person at this value and they are related. So you'll find that that's also another win for the importer. He has some rights. And then you have Article 11. So in case you can say a dispute arises between the importer and the customs officer because of the value that has been declared. So the importer can appeal, so that not appeal, but they can appeal for that value. So you appeal to the next level. So maybe if you are at the point of entry and maybe the value was uplifted, then in case maybe the importer feel aggrieved, then he can appeal to the next level. Maybe they were dealing with the customs officer at the field. Does he have maybe a supervisor at that station? So you find that he can appeal without any penalties. So he can appeal and see whether whatever value he has declared, he is able to support. So there's that appeal, another right to the importer. And then Article 12 explains the obligation of members to publish laws. So there's need to publish. Is the information there? What method of valuation is applicable in your country? So publish information relating to customs valuation. So publishing does not mean that there is hard paper copies. It can be in any form. Are you able maybe to have brochures at customs offices where maybe an importer comes and it can be given a brochure to read? Are we able to have maybe call centers? So you want to import a motor vehicle, you want to know how much it's going to be valued for and how much duty you're going to be paid. Are you able to have a number you can call to get that information? Are you able to have maybe service desk where maybe someone can walk in and talk to our officer and get that information? Are there any other form of broadcast that can be used to deliver or to convey that message on how customs valuation is applied by customs in the country? So publishing is not limited to paper, not limited to only paper, but any form. Even if maybe there's a program on the radio, that is also publishing information. There's a podcast telling people how customs value the goods. There was a time there was a space on Twitter on how valuation is done. Then still that encompasses publishing. So it's not limited to paper, but any form where information can get to the importers or people who might want to use that information in relation to valuation, then that is publishing. So there's no strict way of publishing, provided that information is going to be able to reach the relevant stakeholders. And then Article 13 talks about guarantee system. So remember, we have said there may be a dispute. So if there's a dispute, so the importer is not convinced the value that he has been given is the right one, and he has appealed, so he has appealed to the supervisor of the officer, but maybe in the process of awaiting the appeal to be addressed, he can be offered a guarantee. So he can have the goods released to him, but under a guarantee while he sort out the issue of that dispute. So you find that this is also another good right for the importer. He can get a guarantee, so it means that he's able to maybe continue with the business. Maybe he's a trader, so he is able to sell the goods because he has put up a guarantee, maybe awaiting the determination of the appeal. So you find that a guarantee is available if there are any dispute. And then Article 14, you'll find that under the annex, you can say, sometimes you'll find that there are annexes, and basically the annexes explain better what is required and maybe in the provisions in that agreement or in that legal document. So you'll find that sometimes you'll find that those annexes, some people might ignore and kind of not take them as part of the main agreement or the main legal document. So Article 14 clarifies that Annex 2, 1, 2, and 3 form integral part of agreement. So whatever is said in Annex 1, 2, and 3 still you can say can be used to complement whatever is in the other articles. And then Article 15, there's some definition. Remember I said most of the legal documents may have some definitions in relation to that legal document. So you'll find that it will define some of those terms when we are using them in relation to customs valuation. And then Article 16 explains the right of importer to a written explanation at how the customs value was determined. So remember, when Article 1, which is transaction value method, is not applied, the other methods may be used, but we find that in case the importer feels he is aggrieved, then he can request for a written explanation from customs. Why customs used maybe method 3 instead of the value that he has declared. So good for the importer, they have rights. And then we have Article 17, explains the right of customs administration. So customs administration are not left out, they still have also right for themselves to satisfy themselves that whatever information the importer has provided is enough for them to determine the value of the goods. So if maybe the importer only attached an invoice with no other documentation, and this customs officer feels that this value declared is very low, are there any documentation that the importer can provide? So he can request the importer to maybe provide maybe a finance document. So document that show that payment was done, so that they can be able to relate the amount on the invoice and the amount that was actually paid to the seller. So you'll find that Article 17 does not mean that all the importer has all the rights. It means also the customs officer has the right to request for more information if convinced that information provided that does not help them to determine the customs value of the goods. So that's Article 17. So we move on to Article 18. So Article 18 encourages the establishment of a committee on customs valuation, which will oversee the implementation of the agreement. So Article 18 is establishment of the Committee on Customs Valuation. So the committee will ensure that the agreement is being implemented, and if maybe there are any issues, they are able to be addressed. So Committee on Customs Valuation. And then Article 19 talks about consultation and dispute, especially in relation to when the dispute is between countries. So you'll find that we are so much used to valuation dispute being between the importer and the customs officer, but you'll find that disputes can also arise in relation to customs valuation between countries. Remember, when these values are uplifted or they're given higher values for goods imported into the country, somehow, especially if it's a common practice for goods maybe coming from a certain countries, then you'll find that that may lead to a dispute between countries. So remember, dispute is not just only between importer and exporter, but it may escalate to dispute between countries. But you can say dispute between countries in relation to customs valuation is not that common, because you'll find that people will kind of get back to each other in terms of tariff. A good case is the Trump and China tariff escalation. So Trump uplifting the tariff rates, and then China countering the same. So you find that for customs valuation, the dispute is not so much on maybe higher value being used, but you'll find that it may relate maybe to the tariff rates that are being applied. So the most common dispute in customs valuation is between importer and the customs officer, where the customs officer may increase the value, while the importer may not be convinced why that value was increased. But there's possibility that a dispute might also occur between country. And then Article 20 is special and differential treatment. Special and differential treatment, SDT. So you find that there are those countries that are developing and least developed countries, so they may not be able to implement the obligations required by the provisions of the agreement, so they may require assistance, especially in capacity building. So you'll find that the agreement has given that provision that in case maybe those least developed countries may require assistance, then the developed countries can be able to assist in order the agreement can be implemented. And then Article 21 is on reservation. So Article 21 reservation means that if a member, which is a country that is a member of the WTO, feels that one of the provisions in the agreement maybe does not favor them, or maybe they don't want to apply that provision, then you'll find that they'll have to register a reservation. And if they register that reservation, it means that all the 166 members of WTO have to, 165, since one of the member is the one that is registering a reservation, so the remaining 165 members have to consent. So the remaining 165 members have to consent for that reservation to take effect. We can give an example where maybe in Kenya we say we don't want to apply Article 1, the transaction value method. Maybe we have seen that importers do not make the actual declaration, maybe they use forged document, the values are too low, so we don't want to apply Article 1. So we want to make a reservation that in Kenya, when we are valuing goods, we're going to start from Article 2, which is transaction value of identical goods. So if we want to make that reservation, we have to convince the 165 members to give consent so that we don't apply transaction value method. And then we have national legislation. The way I say that, we need to, you can say, domesticate the agreement to our national legislation. So either national legislation or regional legislation, depending on what customs legislation is being applied. So for us in Kenya, we are applying the East African Community Customs Management Act. So it has provisions concerning valuation of the goods. And then we have Article 23 is review. So you find that the committee review the agreement to see is it, you can say, implementable, are there any issues that are arising, so there's need to review. And then Article 24, there's the secretariat. And then we have Annex 1, where we have the interpretative note, so there's more information in relation to certain articles. And then Annex 1, Annex 2, and then Annex 3, which we have seen that they all form an integral part of the agreement. And this is all for this session. I hope you have enjoyed. So remember, if you are taking notes, if there are any issues that are not that clear, feel free. When we meet for the discussion, you can be able to raise them and we will learn from each other. So thank you so much and take care.